my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Sales International Limited. And here is your weekly technical analysis of New York and London sugar markets. I'll start with ICE New York Sugar. Prices peaked out and then headed back down 2 weeks ago. I'm still not sure if it was the 21st century 50% absolute Fibonacci line at 1809 or the approach to the middle time, which was then nearby, currently at 1904, of the December 2020 to April 2021 Andrews pitchfork. That was the cause of it, whichever one. I have to say, whilst it is not a wholly untested pitchfork and therefore to be taken cautiously, it still has merit. Anyway, it could even be a combination of both of those resistances that capped the market. The result was we saw prices peak and drop off down to the previously highlighted congestion below between 1630 and 1680, where they stabilized on Friday last week and yesterday as well. Now, this stabilization was shown as a period of heavy intraday indecision, with a bearish opening Black Marobozo followed by an immediate countering bullish Harami, then by a counter to the counter bearish below the stomach pattern, and finally yesterday, at least until now, a third countering bullish piercing line pattern, well into the depths of the congestion mentioned above earlier between 1630 and 1680. It's worth pointing out now that in the depths of the congestion we now have also both the rising medium moving average currently at 1639, also the short medium moving average currently 1636, with the lower time of the same December 2020 to April 2021 bullish Andrews pitchfork about to enter the congestion zone. That's currently at 1626. There are two additional factors one should take into account. The last 2 days, even with today looking like a bearish spike right now, almost made a possible weekly key reversal. Today's high is so far 1727. If in the next 3 days this could be extended upwards to 1737 or higher, then the conditions will be right for a possible weekly key reversal this week. Something to bear in mind. The other feature is a fresh February to May bearish Andrews pitchfork. Now, this one is completely untested, but I'm mindful that the upper time, currently at 1770, may have some utility. So I thought it opportune to mention it. I'll finish with two questions I asked from last time, and I quote: is the action over the last 2 weeks a type of halfway hesitation, maybe leading to a measured move higher, or is it a nascent double top? I'm not sure as yet. End of quote. Well, it sure hasn't been a halfway hesitation, but the idea of a double top formed over the recent mid-April to date action has some merit and one worth keeping an eye on, as well as the larger 2021 action itself. ICE Europe white sugar contract. Once again, compared to the New York contract, this one in London continues to be different. Primarily, the April to July bullish shift pitchfork has worked and continues to work after a fashion. Please don't get me wrong, it has been broken, but at the turn of March into April, but it has also seemingly repaired itself enough to function and still seem important, especially 4 weeks ago and again 2 weeks ago when the middle time, currently at 498.40, capped the rises, though obviously not on a first attempt in either case. Additionally, only yesterday, the lower time, currently 444.60, halted the decline we saw from 2 weeks ago when the middle time stopped its rise. Interestingly, much as in the New York contract, the action over yesterday and today, including the little gap today, have almost set the criteria for a weekly key reversal. We need a high this week of 461.10 or higher to set up for a weekly key reversal, and so far we've managed 459.90, even if today has now managed to look like a bearish, well, not even a bearish looking, but looking like an indecisive spinning top at the moment. However, I should point out that below we also have the lower time, currently at 443.90, of the newer and more acute December 2020 to April 2021 bullish Andrews pitchfork that has reinforced the original lower time and will cross over later this week. So You can see the support exclusive of the 50% Fibonacci line at 452.30, the medium moving average currently 450.40, the short medium moving average at 450.90. Well, all of it's in good shape. Two final points. The April and May high have also set up the opportunity for a double top, but it is still early on that. And finally, I've drawn a fresh February to May bearish Andrews pitchfork. The upper tie, currently 475.30 of this, is the likely nearest, but this is purely speculative on my part, and I'd be happy to retire it if it fails under stress. Sugar white premium spread. The recent move lower started in late April with a reactionary bearish harami after the market had made a combined weekly key reversal up and bearish double the previous week. However, this weekly bearish harami punched down through the long moving average, currently 89.5, and the medium moving average, currently 91.5, and dropped the market back down into the congestion zone between the neckline of the failed head and shoulders top, currently at 75 even, and the big old 50% Fibonacci lines of July 2019 to May 2020 move at 80.25. This discounted the spikes below it to a certain extent, as there were no closes under the neckline, but it does acknowledge the halt in the 70 even area and move back up. To actually expand on that, since we've seen the market drop down to this seeming old congestion zone between 80.25 and 75 even, we've not been able to close outside of it despite forays higher for 4 weeks now. And we've seen 2 of those weeks with indecisive doji crosses and 1 with an indecisive spinning tops. Now this echoes what was going on back between September to October last year, and then again between November 2020 and January 2021. This was prior to the break higher, yet still below what was managed back in 2020 as a high or highs. I have a suspicion that, like the earlier efforts within this congestion zone, we may be here for a little while yet. One final point, we have had a dead cross of the short medium moving average, currently 89.25, punching down through the long moving average, currently 89.5. This is seen as a bearish indicator, if a lagging one. However, it is still worth remembering as well. Thank you for listening to this weekly broadcast with essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.